Welcome to the Deep Dive. Today, we're immersing ourselves in the renewed U.S.-China trade tensions. We're digging into a stack of sources mostly focused on these shadows of trade wars.
Yeah, that's the core theme.
And our mission really is to cut through all the noise and give you the essential knowledge, sort of a shortcut to being well-informed on what looks like the biggest economic clash looming. And this isn't just, minor duties. We're talking a potential full-blown showdown, specifically around this threat of 100% tariffs on Chinese imports.
That threat is really what's driving the immediate uncertainty. The sources we looked at really highlight how this is where international politics just slams into high finance.
Right.
This threat of duties possibly hitting November 1st, 2025. While it signals a really fundamental clash of economic models, it's forcing the leaders, both leaders, to the negotiating table under, frankly, immense pressure.
That's the clock ticking then.
Okay.
So let's unpack the immediate stakes. The fundamental tension here is this collision, right? You've got the U.S. economy, very consumer-driven, relying on affordable imports, think smartphones, EVs, all that stuff.
Right. Everyday goods.
Meanwhile, China's engine is strategically, deliberately export-led. So if this 100% tariff threat actually happens, the impact could be, well, seismic immediately.
Yeah, the domestic ripple effect in the U.S. would be immediate. And painful. Tariffs, at the end of the day, are taxes paid by the importer. That means U.S. consumers basically absorb the cost.
Right.
So this could drastically hike prices for, everyday necessities, lots of imported goods. It directly fuels inflation. And that puts considerable strain on households, especially with the post-pandemic recovery still feeling a bit shaky for many.
And then there's the corporate pain. That's absolutely central in the source material we review. I mean, think about the American tech giants, your Apples, your Teslas. Companies just deeply reliant on the efficiency and scale of Chinese manufacturing.
They're stuck.
Exactly. They face two really bad options. Either absorb these soaring costs on finished goods they import, or try some kind of rapid, probably messy diversification.
And diversification, well, it's not quick. It's not easy. Our sources suggest that just shifting, say, 20% of high-end assembly capacity out of China, that could take at least 5 years.
Wow.
Minimum.
Wow.
And requires billions, literally billions, in new infrastructure investment. So for many companies, absorbing those short-term cost increases becomes almost inevitable, practically speaking.
But the issue goes deeper than just assembly lines, doesn't it? It's also about the raw materials feeding into them. We have to talk about the linchpin. Semiconductors and their supply chain.
Absolutely. You can't avoid it. China's dominance in rare earth minerals is kind of the hidden leverage point here. These are absolutely crucial components for high-tech manufacturing. Any sustained disruption from tariffs could trigger shortages of those minerals. And those minerals are needed for everything from, cutting-edge AI chips to essential renewable energy tech. It's a bottleneck that could slow down global technological progress seriously.
Okay, let's flip this. How is Beijing likely viewing this? The immediate hit on China would be severe too, right? Mainly because the U.S. is their largest single export market.
Oh, definitely. We're talking about potentially massive economic displacement. Think about manufacturing powerhouses like Guangdong province. It counts for nearly a quarter of all China's consumer exports.
Huge number.
Huge. So idling factories there would directly worsen domestic problems, like the already high youth unemployment rate, which is a major concern for them.
And we have to assume retaliation based on last time.
I think it's almost certain. Based on the 2018 playbook, China won't just, absorb this hit passively. They're likely to respond strategically, perhaps hitting U.S. agricultural goods again. That really hurt American farming states before.
Yeah.
It becomes this punitive cycle that just ends up damaging producers on both sides of the Pacific. Nobody really wins.
So, okay, that covers the immediate U.S. and China headache. But given how interconnected everything is, the global supply chain, this quickly stops being just a bilateral fight and becomes global collateral damage, right?
It really does. Export-heavy economies worldwide are suddenly at high risk. Take Germany, for example. Its massive auto sector relies heavily on sophisticated components, often sourced through complex Asian supply chains, many touching China.
Right.
Japan, too, with its precision machinery. Similar exposure. If those U.S.-China trade links get severed or even just highly uncertain, it immediately slows down global commerce for these, well, innocent bystanders.
But the sources also flagged the other side of that coin. Trade wars, messy as they are, always seem to create opportunities for third parties.
That's correct. You see emerging players, India, Mexico, various nations in Southeast Asia, they're actively courting factories, looking to flee the storm or at least hedge their bets.
Like Vietnam did before.
Exactly like Vietnam. They successfully positioned themselves as a key alternative manufacturing hub during the 2018 friction, and other countries are definitely keen to replicate that success, offering incentives, building infrastructure, trying to lure that investment.
Okay, let's talk money. What about the financial market reaction?
Hmm.
Markets hate uncertainty. They usually price this stuff in early, and they tend to speak pretty loudly.
Oh, we've already seen volatility. Stocks, Wall Street, Shanghai, they've dipped sharply just on the threat of these duties.
Mhm.
Investors are clearly fleeing risk. We see them moving into traditional safe havens, gold, U.S. treasuries. That typically signals a big drop in global risk appetite.
And if that volatility keeps going, what happens with the yuan, China's currency?
Well, if confidence keeps eroding, the yuan is likely to weaken under the strain. Now, that could actually help cushion the blow a bit for Chinese exporters, making their goods cheaper abroad.
But there's a catch.
Oh, yeah, a big one. Beijing has to tread a very, very fine line. If they let the currency fall too fast, too far, it risks triggering significant capital flight. That's when investors, both foreign and domestic, rush to move their assets out of the country, and that could potentially destabilize their entire financial system. So it's a real balancing act for them.
Okay, so to really get our heads around the seriousness of this 2025 threat, we probably need to look back at the 2018 trade war, right? That feels like the blueprint. It shows just how fast things can escalate.
It really does. It started relatively modestly, remember, duties on steel and aluminum, but it snowballed incredibly quickly.
Yeah.
The initial phase escalated rapidly to cover about $50 billion worth of targeted tech goods. Then came duties on another $200 billion in broader consumer products. I mean, this barrage fundamentally reshaped global commerce.
And both sides felt the pain.
Definitely. Both paid a heavy cost. U.S. exports dropped by billions. China's growth slowed to its lowest point in nearly a decade. It wasn't trivial.
And Washington's moves weren't just tariffs either. The U.S. also tightened scrutiny on Chinese investments, particularly in Silicon Valley, and famously blacklisted key tech firms, Huawei and ZTE come to mind.
Framing it explicitly as defense against forced technology transfer and intellectual property theft. That was the stated rationale.
Right. And Beijing's counter demands, they were also focused on market structure, weren't they?
Yes, very much so. They demanded fairer access for U.S. firms, pushing back against things like restrictive joint venture requirements in sectors like autos, and also challenging strict data localization rules that tended to favor their domestic competitors. It was this complex battle fought over market share, yes, but also technology standards and ultimately trust.
Which brings us to the Phase 1 deal in 2020. It sort of paused the immediate pain, but the sources we read are pretty clear. Trust never really recovered.
Not at all. That deal primarily committed China to buying an extra $200 billion in U.S. goods and services over 2 years. It was a commitment they largely failed to meet, by the way.
Right.
So the agreement really just kicked the can down the road. It postponed the conflict because the underlying structural imbalances, the core disagreements, they were never resolved. And that fragile situation just set the stage for the brinkmanship we're seeing now. We pull the lens back even further, connect this history to sort of broader patterns of superpower competition. The current situation has these, uncomfortable parallels to America's trade wars with Japan back in the 1980s.
Ah, the Japan parallel.
Yeah.
Okay.
Back then, Washington was just as vocal, maybe even more so, complaining about Japanese exports, cars, electronics, steel flooding the U.S. market. And there were similar accusations about currency manipulation, keeping the yen artificially low.
And that led to a really decisive high-stakes move, the Plaza Accord of 1985. Could you remind us what that was?
Sure. It was a multilateral pact involving several major economies, but the core goal was to force the Japanese yen to appreciate sharply against the dollar, make Japanese exports significantly more expensive, essentially leveling the playing field, or so the thinking went.
Okay, so they forced the yen up. What happened next?
Well, this is the crucial part, the unintended blowback for Japan. As the yen strengthened, Japanese exports did become pricier, and their famous competitiveness started to wane. So to try and maintain growth, what did Tokyo do? They desperately tried to compensate by pumping enormous amounts of credit into their domestic economy. And this strategy, it inflated a truly catastrophic asset bubble, both in property and in stocks.
The scale of that bubble. Hard to even comprehend sometimes. The source material details how Tokyo land prices, at the absolute peak, briefly outvalued the entire landmass of the United States. It's insane.
It was utterly insane. And the Nikkei stock index tripled during that frenzy, just fueled by easy credit and wild speculation. It was completely unsustainable.
And the crash.
And when that bubble burst around 1990, the country just plunged into what became known as the lost decade, although some argue it lasted much longer. It was an era defined by crippling stagnation, persistent deflation, falling prices, which sounds good but is terrible for an economy, and the rise of these so-called zombie banks.
Zombie banks.
Yeah, banks that were basically insolvent but kept alive artificially by government support. They couldn't really lend properly, and they just choked off economic dynamism for decades. Japan is arguably still dealing with some of that legacy.
Wow. That history, that total collapse driven by that kind of credit expansion, that's got to be a terrifying echo for policymakers in Beijing right now. You have to wonder if they're watching those old tapes.
You'd think so. And, critics look back and argue the Plaza Accord wasn't just about economic fairness. They say it was also about strategically containing a rising economic rival, a geopolitical motive.
Which sounds awfully familiar.
Exactly. It's a motive that many people today apply to the current U.S. strategy towards China, particularly regarding Beijing's rapid technological ascent. Is it just trade or is it containment?
So let's take that Japanese shadow, that whole experience, and apply it directly to China today. Like Japan back then, China's export-led system is under immense strain. It powers roughly a third of its GDP. But it's also facing these major internal vulnerabilities, things Japan didn't necessarily have to juggle all at once.
Right. Things like a rapidly aging population, deeply indebted local governments, and, of course, a colossal property sector still reeling from the fallout of developers like Evergrande collapsing.
It's a lot to handle simultaneously.
It is. And this specific mix of factors helps explain why the risk of history repeating itself feels so acute right now. If these major tariffs hit hard, and if the yuan depreciates significantly to try and cushion that export blow, China might be tempted, maybe even feel forced to stimulate its economy with easy credit again.
Just like Japan did.
Exactly. And that risks inflating their own asset bubbles. Maybe another round of real estate speculation, or maybe a stock market frenzy this time. It's a dangerous path.
So what does this imply for the future shape of the Chinese economy? The necessary transition, the one everyone talks about shifting to a more robust, consumption-led model that requires huge, politically really difficult reforms, doesn't it?
Absolutely huge. Things like easing credit access for households, not just state-owned enterprises, bolstering the social safety net so people feel secure enough to spend, and deliberately fostering the service sector over the entrenched factory networks. These are major structural changes.
And that bumps up against the fundamental tension we see again and again. Political control versus economic dynamism.
Precisely. We saw the incredible promise of, say, fintech pioneers like Ant Group, remember, blending AI with lending, potentially empowering small borrowers, driving efficiency.
Yeah, it seemed revolutionary.
It did. But that dynamism was then sharply contrasted by the reality of swift, heavy-handed regulatory clamps, the very public humbling of figures like Jack Ma. It illustrates exactly how narrow that tightrope is for Beijing. They want innovation, they need growth, but they seem to fear losing control above all else. #tag outro.
Okay, so as the two leaders, President Trump and President Xi, approach this really crucial summit, the sources seem to suggest two starkly contrasting paths forward. This meeting feels like much more than just a tariff truce negotiation, doesn't it?
Oh, much more. It could really define how this rivalry is managed or mismanaged in this new era of AI, green transitions, and intense technological competition.
So what would a good outcome look like, realistically?
Well, a deal that averts the immediate threat of 100% duties, perhaps even just a temporary framework agreement that buys more time, that would certainly allow global supply chains to continue diversifying, maybe in a slightly more orderly fashion.
But that's not a permanent fix.
No, absolutely not. Crucially, without addressing the root structural imbalances, particularly around intellectual property, market access, and the ongoing pressure on critical supply chain resilience, another flare-up down the line seems almost inevitable. We'd just be kicking the can again.
So for you listening, the big takeaway from these sources seems pretty profound. In these kinds of trade wars, nobody really achieves a clean win. The real battle being waged right now underneath the surface is arguably for the future of the rules-based international order. Can it harness this kind of strategic economic competition without letting it spiral into global catastrophe?
It's the key question. And as these tense negotiations unfold with the heavy weight of history, especially that Japanese parallel hanging over them, there's one final question lingering, something for you to really consider. Will history inevitably repeat itself, potentially dragging Beijing down a path similar to Japan's lost decade? Or is there still a chance that cooler heads can prevail and finally succeed in rewriting the script?